Next, let's welcome Mani Mahadevan, who was in San Francisco working for the enterprise platform Medallia, which was about to go public. And he went down the rabbit hole to figure out how to really think about tax planning because it makes a huge difference. And you're going to hear the shocking stats about what he's been doing. But he started the company Velour in order to help founders, advisors, investors really think about tax planning proactively. And since then, just in the last year alone, he saved clients more than 600 million in wealth, or created more than 600 million in wealth from tax savings. And not surprisingly, he moved from San Francisco to Miami, so you might want to ask him about that too. But without further ado, please join me in welcoming Mani. And Mani, let's make this real for people. Why should founders care about tax planning?
Appreciate it, Anne, and excited to join and chat with kind of the audience here. So, simple reason of why you should care about tax planning is it'll allow everyone here to keep more of their hard-earned gains. And like tactically, you're wondering, what does that mean? This can more than double how much wealth you create over your lifetime with tax planning. So if you're talking about let's just say a $5 million exit, I know everyone here is thinking about much larger exits. With tax planning, you can create an additional 12 million or more in after-tax wealth just from using tax strategies. And this is kind of a lot of times you often hear this thing of work smarter, not harder. This is like one of the best examples. They say there's two things that are true in life: death and taxes. You're going to pay taxes. And so the really thing you should think about is, for everyone here who's grinding and building their companies, is how do you maximize the financial value you're able to take home from the value you're creating in the world. And that's really kind of what tax optimization, tax planning is all about. And that's kind of hopefully kind of these numbers give you a little bit of like why you should care, and that you really should be thinking about this stuff as you're building these kind of incredible companies.
Yes, and it seems like small moves can have a huge difference. So let's start at the very beginning. What are the options to consider in the early pre-seed and seed stage as things are need to be done now?
Yeah, it's a great question. So early on, and just to kind of help separate the mentality you think about, in early stages, you're really trying to set yourself up for success. Typically, liquidity exits aren't on the horizon. So you're not necessarily thinking about how do you sell the assets, but you're thinking about how do you own, or what's the right way to own these assets so that you can minimize your future tax burdens. So the biggest thing here is typically early exercise for folks. And this is where hopefully everyone here, if you're a founder, you've early exercised all your shares. And if you have early team members, founding team members, you should encourage them, make it accessible for them to early exercise. And the real reason behind this is the simplest and easiest way to lower your tax burden. This isn't even getting into more kind of complex strategies, things I'm sure you've heard about, TILA, trusts. By early exercising your shares, you can pull forward your tax obligations, and at the earliest stages, those tax obligations are typically minimal to non-existent. So you can essentially prepay a non-existent tax burden now and avoid paying those taxes in the future and lower those tax burdens. And kind of its simplest way is, hopefully everyone here is familiar with your ordinary income tax rates, what you pay on salary, and long-term capital gains tax rates, which is what you pay when you sell stocks or assets you've held more than a year. And exercising and allowing your team to exercise it enables you and them to shift that burden from ordinary income tax rates to long-term capital gains tax rates. And it's just one kind of tax planning way to lower your tax rates. So the simplest, but really something that everyone should be encouraging. As you move towards the later stage, it really becomes down to the big things to start and think about is, how are you going to use this money? Are you planning to use that money for you, a spouse, and planning to use it during your lifetime? So this is where you're focused on tax planning and how do you reduce capital gains taxes, ordinary income taxes. Or if you start to have more and more wealth and you're thinking about, how do I pass this on to my kids? You're thinking about what's called estate planning. And this is, how do you minimize what's called an estate tax? Or if you're creating generational wealth, you can be focused on dynasty planning. So as you get to kind of closer towards liquidity and this exit, it's really, what are you solving for? Who do you want to use this money and have the most possible kind of assets to utilize?
Okay, so let's break it down. Can you walk us through the different kinds of taxes Because
Yeah.
sometimes we hear these terms, but we don't really understand them from an
Yeah.
expert like you. So maybe capital gains and income, et cetera.
Yeah, exactly. It's helpful to start with kind of the basics. So hopefully I'll start with the most kind of basic is the income tax or ordinary income tax. Uh, Probably, unfortunately, everyone here is familiar with it. This is what you pay on salary, W-2. When you exercise your options, it's the tax rate you'll pay on that. So this is typically the highest tax rate. And if you're a Californian or New Yorker, you may pay more than 50%. This is the government taxes this on W-2 income, and it's the highest tax rate at the federal and state level. Now, kind of the next most common tax is what's called the capital gains tax. And there's two types of capital gains taxes, two common types. There's short-term capital gains and long-term capital gains. Short-term capital gains is when you've held so capital gains applies to assets that you've held or investments. So most common for most folks, it's going to be public stocks, or in this case, your private stock in your startup. Could be cryptocurrency, commodities, your real estate, if you own property. If you've held an asset for more than a year, you qualify for long-term capital gains. If you've held it for less than a year, it qualifies as short-term capital gains. And short-term capital gains is essentially, it's the same thing as ordinary income tax rate. So effectively, if you hold assets for less than a year, you're going to pay a higher tax rate that's the same as what you'd pay on your salary. Now, long-term capital gains, it depends on a state-by-state basis, but at a federal level, it can be fairly significant. You can jump down from a 35% tax rate at the federal level to 20%. So, and this is kind of to the earlier point of just by shifting from ordinary income to long-term capital gains, you can save yourself a significant amount of money and create more wealth for yourself. Now, from here, we'll probably start to talk about a little bit about taxes that some of you may be less familiar with. So there's what's called the estate tax. The estate tax, and this generally doesn't apply to most people. Now, hopefully everyone here is creating generation defining companies, and this is one of those good problems that you have to deal with. So the estate tax currently, if you're trying to pass on more than $12 million over the course of your life to your kids, you have to pay any amount over 12 million, you start to pay what's called the estate tax. There's federal and state estates. The federal estate level tax at over 12 million starts at 40%. So essentially, if you're trying to pass on more than $12 million to your kids, you're going to lose 40 cents out of every dollar to the federal government. That's not even including state level estate taxes. And so this is where the taxes really ramp up as you're dealing with more money. Kind of the other tax is it's called the generation skipping tax. This really deals with kind of dynastic wealth. So we're talking 50, 100 plus million, where you're typically not worried about spending all that money during your lifetime, your kid's lifetime. You're really thinking about how do you set yourself up for kind of almost an indefinite future. And it's very similar to the estate tax, but it's taxes focused on when you pass on assets to 2+ generations from now. And so like what you're starting to see, it feels like these taxes do ramp up. And I'm sure everyone's seen this. As you typically earn more, you start to pay more in taxes. And it's part of the progressive tax system that we have built. Now, kind of an interesting or sad fact, depending on how you look at it, is generally in the US, you see this as people build more wealth, they pay more in taxes. Now, it tends to be true until you get to really the top level of society, because essentially the tax code, it's funny, Anna and I have chatted about this. The tax code in some sense is a game. Right? It's a game that ultimately impacts all of us and has huge financial impacts. So, and when you have this level of wealth at the top end of society, you can really optimize this game. And this is the 400 richest Americans, as an example, pay lower effective tax rate on their realized income than the bottom 50% of society. And this is really where you see tax optimization and tax planning at the highest level, is those folks with the resources and the incentives to do so really optimize in a way that is typically inaccessible to everyone else. And this is where whether it's knowledge of even knowing what these opportunities are, which is a big part of, we want to introduce you to some of what those topics are, to executing it. It's typically where folks like you typically miss out, and you end up kind of in this, it's actually not the sweet spot. It's the exact opposite, where you're earning enough to, have meaningful income, but typically not having access to those solutions where you can kind of maximize what you're able to keep and grow for your family.
Perfect. Okay. And let's jump into very tactical early stage planning. Um, do you have guidance on filing 83Bs for either
Yeah,
founders, early team members, or advisors?
yeah, exactly. So the earlier stage of the company, the lower your valuation, the more valuable it is to ensure that your teammates can early exercise. So for context, an 83B, it's a tax filing that allows you to exercise your options that you either, as a founder, you've given to your early teammates, advisors. Now, the reason to do this is typically at an early stage. There's when you have options, there's a couple of different key kind of metrics that there's a strike price, which is the price you can exercise your shares at. There's a fair market value. The typically over time, as your companies do well, your fair market value increases. When you exercise your options, you have to pay the strike price to the company, but the government gets its share of this money too. And the difference between your strike price and the fair market value of the company gets taxed at ordinary income tax rates, which again is the highest tax rate. Now, at the earlier the stage in the company you are, typically the spread between the fair market value and your strike price is negligible to non-existent. And so this means when you exercise, if you early exercise in the early stages, you'll have no tax liability and the strike price is essentially non-existent. So this is where things you should be doing is you should ensure, and this is fairly standard in kind of Silicon Valley, startups, most law firms, Stripe Atlas, whatever you're using that allows these 43Bs and early exercises, 83Bs as part of setting up your company. If it isn't, you should figure out how to enable that. And you should also encourage your early advisors, team members to do this. One of the things to call out is as it gets later stage, the decision becomes a little bit more, it's not quite as clear of a decision of whether people should be early exercising because, again, later stage, the fair market value increases, there's more tax liability. And this is typically, and this is even as like a, early stage investor, and you can probably speak to this well, right? The upside versus downside, there's a significant more upside at the early stage versus the later stage, right? The amount the multiple that the company can increase can only grow so far. So exactly. At later stages, your employees are thinking about the tax liability now versus how much can that value really increase in the future, and it can be a little bit of a tougher decision. But early stage, you should be encouraging folks to do it. Yeah.
Yes, that's right. It's such asymmetric upside. And actually, that reminds us of a tweet actually from Compound, the company at Compound. Yeah. And they said, Figma, I think, was started in 2012 or 2013. So people definitely should have bought their, founder stock or their options then. But if you joined Figma in 2018, so not that long ago, and they had just started doing revenue at that point, if you received 250,000 stock options and exercised them all, your net outcome today would be over $8 million. If you waited until the acquisition to exercise, you'd take home 7.5. So that's just by doing that delta, you cost yourself 650K. And that's big, but it really emphasizes what if you had done the super early exercise, in 2013, right? Huge outcomes.
Yeah, 100%. I think that's a good example of it. This is where candidly, it's even understating. This is where you get into some of the more advanced kind of tax planning things. You use trusts, tax exempt structures, and they're talking about the difference between 7.5 and 8.1. The net delta actually becomes somewhere between 7.5 versus 14 or 15, and so the upside becomes even greater. And this is kind of one of those this is the stuff that isn't really shared is. The earlier your cost basis and when you own these shares, there's more tax, estate planning movement you can do with your shares to really capture more of this upside for yourself and set your family up.
Okay, cool. All right, so now let's move to the very hot topic of QSBS. Can you take us through that?
Yeah, so QSBS, it's a hot topic in a number of ways where it is, as founders, everyone in this room this is one of the top things you should know outside of running your day-to-day business. It's also a political hot topic because over the last couple of years, it's twice been kind of been part of legislative proposals to actually reduce QSBS benefits. So right now, it's kind of at the peak QSBS benefits we've ever seen and may ever see because there's momentum moving against it. So what is QSBS? QSBS stands for the Qualified Small Business Stock Exemption. And the idea behind this is the government wants to encourage, the government views small business as the job growth engine and innovation engine of America. And so the government created QSBS to essentially give a tax break to founders, employees of small businesses, and investors in small businesses. They're trying to encourage more investment, more people to start, more people to join these small businesses because they view this as good for America. Now, very high level, what does that practically mean? So essentially, the government, if your company qualifies, we'll run through that in a minute, they give up to $10 million per individual per asset of tax-free gains on QSBS eligible equity. So what this means is at the federal level, you can avoid federal capital gains and net investment income taxes on your first 10 million plus more with kind of some other things that we'll talk about on taxes, which is, it's the best tax break around there. This is where candidly, you don't need a ton of fancy accountants, lawyers. If your company is eligible for QSBS, you should know what it is because this is going to be on your first 10 plus million and more. The best tax planning you can do is just being aware of this and making sure you take advantage of it. Now, how do you know if you're eligible? There's a couple of key things. So one is you have to be a US-based C corporation. For all of you who've taken kind of investments from Village Global, I'm willing to bet that essentially all of you are eligible on that ground. Kind of the other key pieces are that when you receive your equity from the company, you have to have less than 50 million in net assets. So it's somewhat comparable to what was the last round of funding, but not exact, depending on how much money you have in kind of the bank when you receive a round. But it's kind of a good heuristic for employees to know of are their shares eligible. But this is usually at some point when you get later stage, your finance team or legal team will actually be able to offer this. We'll be able to tell employees if their share grants are eligible or not. And kind of the two final key things are, one, it has to be in an eligible industry. Tech companies tend to apply. If you're a pure financial services company, you may not. But pure tech companies, it tends to apply. The last key, and probably the most important, is you have to have held the shares for 5 years. So you can't have started the company last year and sell this year. The government is thinking long-term value and innovation investments. So you have to have owned the shares for 5 years. And a key thing, which probably applies to your employees, it's from when they exercised, not from when they received it. So they could have received the shares 5 years ago, but the 5 years starts from when they exercised.
Okay, so another great reason to early exercise. Okay, and so can you talk about QSBS distribution and structure across trusts and how this all works? Okay.
Yeah, so kind of briefly mention on this, but with QSBS, you are eligible for these QSBS benefits up to $10 million per individual per asset. And one other piece is, so federally, this applies to all federal taxes. In addition, 45 out of 50 states also follow QSBS. So essentially in 45 out of 50 states, you can avoid federal and state taxes on these gains. Now, the key thing with these gains are that it's $10 million per individual per asset. Now, again, and I see in comments, someone's calling out California is one of those 5 states. Other states are applicable are Pennsylvania and New Jersey. I'm sure there's also plenty of you in New York. New York does, QSBS is eligible in New York, so that's kind of a big thing for many of you. Now, the other key piece of this is $10 million per individual per asset. So what this means is, let's just say, everyone here is creating dynastic companies. Let's say you have 20 million in QSBS eligible equity. You can personally claim the first $10 million for yourself. Now, another interesting kind of nuance is if you gift shares to someone else, they also get that QSBS eligibility to the shares. The shares count as if they had received it early on. So from the time from when you exercised it continues to them. So if it had been 6 years, that clock is still running for them. It counts as if they had received it before the company had 50 million in net shares. So as an example, let's just take kind of my company. Let's say I had 20 million in shares. If I claim 10 million in QSBS for myself, but let's say I sold the second 10 million to Anne. Anne's shares would not be QSBS eligible because she bought it from me. However, on the other hand, let's say I gifted them to her, and I know this is somewhat of a legal nuance, then Anne's that 10 million would be eligible for QSBS, and she could claim her own second QSBS exemption of 20 million. So all of a sudden, that 20 million shares I had going from a 10 million exemption to two $10 million exemptions and 20 million. Now, Anne mentioned trusts. Now, an interesting kind of quirk, or depending on how you look at it, the US tax code is, there's kind of this famous court ruling where they ruled that corporations are people too. It's caused a lot of debate in US society if that's good or bad. But the fundamental truth is it's true in today's world. And this applies to trusts. So one of the ways, there's this term called QSBS stacking and packing. And really what it's referring to is you stack these QSBS exemptions on top of each other. So a common way that people will do this is they will gift their equity to either kids or trusts that the kids are the beneficiaries of, or particular trusts that they can get the money back. And each of these qualified trusts can get their own QSBS exemptions. For instance, there's things called Ing Trust, which some of you in California may be familiar with. There's also things called shareable remainder trusts. These are common structures where founders, let's say, in my case, I have 20 million and I've claimed 10 million for myself. I may gift my shares to a charitable remainder trust. That charitable remainder trust, when it sells, because it's its own taxpayer, it gets its own QSBS exemption, and so can claim $10 million exemption, sell the assets, and then distribute that money back to me. So in kind of with a step in between, I'm effectively able to get $20 million of QSBS exemption by using these trusts as a secondary QSBS exemption.
Okay, and just to be clear, so you can just gift without a trust. You could gift from one person to, say, a spouse, a
Yep.
child, whoever you want,
Yep.
right? Okay, and that's fine. But then the other level is you would, for example, talk to a lawyer or an accountant or Valour to set up trusts, and that makes it even more tax advantaged.
Yeah, exactly. You can essentially
Okay.
stack these exemptions on top of each other. I mean, this is one of the things that Valor does, is we essentially automate like setting up these trusts so that it becomes fairly seamless to set these up, move your assets over,
Okay.
and kind of stack these. But that's kind of the idea. Is your first 10 million, you don't really need to think about too much for claiming for yourself. You start to get beyond that. That's when you start to think about if you want to gift it to kids, keep it in your control, and then just stacking these exemptions, because QSBS is really, for everyone here, it's the best tax break around. There's no other way to avoid federal and state taxes. And so when you can claim QSBS, doing that and maximizing it is really the kind of the best
It's a
tax planning.
no-brainer.
And
Yeah.
it's the smartest
Okay.
way to,
Okay.
again, work smarter, not harder.
Great. Okay, so we have a bunch of questions I want to get to. Yael asks, does the time clock reset if a company acquires your equity for cash or for stock? I'm sorry.
It's a great question. So the clock keeps going. Now, the key thing is that company has to be QSBS eligible.
Okay.
So if that company has the same kind of things, US-based C corporation, has less than 50 million in net assets, if, let's say, you've held your shares for 4 years and they acquire you in an all-share deal, as long as they're eligible when they're acquiring and you're exchanging your shares for theirs, the clock keeps going. So if you're at 4 years, then you just need to hold their shares for a year to hit that 5-year clock.
Awesome.
Another
Okay.
interesting, yep.
Go ahead.
I was going to say another interesting piece. Let's say someone buys your shares for cash. You can actually do what's called a QSBS rollover, where if within a certain time period, I believe it's 60 days, if you invest in another QSBS eligible company, the clock can keep going. So in this case of, let's say you get bought by let's say Google buys, there's probably a decent odds that Google probably does buy someone in this chat's company. If they buy you for cash, within 60 days, if you reinvest into another QSBS eligible company, the clock keeps going. So if you've been running your company for 4 years, you would need to invest in this company. As long as that company, you held those shares for a year, when you sell them, you'd be able to claim QSBS. Now, generally one of the challenges we see is, unless you're a professional investor, when you're having these exits, it's tough to deploy at a large enough scale the majority of your funds within that time frame and get high quality investments.
Okay, got it. Okay, and then does QSBS apply to the state you are currently in or the state you are in when you have the financial gain?
So it typically applies to the state you're in when you exit. Now, there are certain states, California, New York, if the exit is within 2 years of you leaving, they might claim that the gain is taxed in those states, in which case, such as California, the clawback rule, it may apply. generally, this is not going to surprise anyone here. California and New York are the two most aggressive tax states, so they will try to find a way to tax
Hunt
it.
you down, yeah.
So just to be aware, like playing games with New York and California is, trying to like leave a day before you sell is not going to be quite as easy as you
Okay,
would like.
so we notice you're in Miami. Okay, so but you mentioned gifting to kids or trust. You could gift to anybody, right? It doesn't have to be a relative. It could be a spouse, but it
Yeah,
could
you
also be
can gift to
your
anyone.
friend or anything. Okay, got it. Okay. Um, and how are the QSBS shares valued for the purpose of gifts?
Yeah, so this is where you get a fair market appraisal of those.
Okay.
Um, and so that's for gifting. And I think this is Jeff who's calling this
Yeah.
out, right? Is there's something called the gift tax, and this also ties to state taxes. Is in your lifetime you're allowed to, so you can give $15,000 per year. That doesn't count towards your lifetime gift exemption. But then beyond that 15,000 per year, you can give $12 million over the course of your life. Over that is where the estate tax of 40+% starts to kick in. Now, just saying, how much are these shares worth? A big advantage that everyone here has is, everyone's seen this, there's your 409A valuation, which is typically fairly close to your fair market appraisal, and there's the preferred price that, right, like investors get. Typically, when you're selling your shares, it's close to the preferred price, and so there's somewhat of this financial arbitrage where you can gift a lot of your shares, and the fair market value is fairly small. Like, I'm thinking about a scenario right now where there's a founder, his equity is worth close to 100 million. The fair market value is 8.5 million. And so there's a lot of opportunity for him to pass on some of that kind of generational wealth to his kids, dynasty trusts, things like that, and set himself up without using his and passing it off at a low value.
100%. Yeah, because the later you go, the fair market value or common and preferred start to,
Yeah, they
start
start
to
to
think. Okay.
converge. Yeah.
Yes, yes, yes. Okay, good. So Brad Kitra said, can a trust be in a state you don't live in? And I can say yes, right? Nevada is very favorable. Probably Valor can help.
Yeah.
Founders figure that out.
Yeah,
Yeah.
yes. This is a big part of this, and this is
Okay.
candidly, it's like federalism lies on. Generally, people try to set their trust up in Nevada and South Dakota are the two most popular states. Um, it's a huge financial arbitrage as well as a way to avoid state taxes.
Okay, good. And I'm adding a lot of value here by reading the questions, which you can also read. But just so, does a post-money safe valuation from a safe count towards QSBS?
Post money count
Yeah, I
towards.
think. Yeah.
I'm not.
I think the question behind the question is, so the post-money safe implies a valuation, but actually so the safe actually has nothing to do with the tax burden. It's really the price of the options, right? The underlying asset.
Well, yeah, I mean, and I think that the bigger part is, right, it's your 10 million of gains. So there's the purchase price you have on. So let's say you're angel investing, right? So, if you're a founder, your shares are, I forgot how many zeros, it's like 0.0001 or is what you exercise your shares at. So you have $10
Yep.
million on gains above that. When you sell it, that's QSPS eligible for yourself. Um, and so that's kind of the post money valuation actually doesn't really
It doesn't
matter at
matter.
all.
Yeah, right.
Yeah.
Your 409A or your founder shares or your strike price and option value. Okay,
Yeah,
that's
that's your
awesome.
cost basis. Yeah.
Okay.
And
Yeah, go ahead.
I see Yael's comment here on
Yeah.
if it's not QSBS eligible. This is where you're probably assuming it's held for more than a year. You're paying long-term capital gains in a normal scenario. But this is where tax planning comes in, and this is where you can actually move it to tax-exempt structures. So if it's not QSBS eligible, you can move it to tax-exempt structures to sell it, right? And let's take a simple example here. Let's say you're selling for $10 million and you live in California. It feels like there's probably the Power Law still sells. There's a ton of founders out there. Normally you'd probably pay 36, 37% in taxes, federal, state. Let's round to 35. So if you live in California, you pay $3.5 million in federal and state taxes. You keep $6.5 million for yourself. There's also, this is where the tax planning piece comes in, or you move it into tax exempt structures where you can sell the assets, keep that 10 million and reinvest it and defer the taxes towards the future. So, and this is where kind of some of the, you can generate even higher returns. This is mentioned this before. Charitable remainder trusts are really common for founders, folks who sell appreciated shares. This is where There's a great, I don't know if anyone here has read like ProPublica. There's been kind of this big expose on how do rich people avoid taxes. This is how Phil Knight sells his Nike shares still on an ongoing basis. But this is where it's like, if it's not QSBS eligible, you start to triage to how else can you avoid or defer taxes, and charitable remainder trusts come into play where you can defer these capital gains.
Okay. Got it. Do you see the question? What does the 5-year clock on a safe start when the safe is issued or when it converts to equity?
Yeah, so this is a really great question. So, and I'll tell you what conventional wisdom on this is. So the conventional wisdom is that it starts after the uh, safe is converted, because the safe is technically debt and you don't actually have equity. Now, so QSBS, the rule behind it is called 1202. It's actually one of the more poorly worded like tax rules. So I also can tell you, I do know people who start it from the day they invest. That's not considered best practices. I'm just telling you that people do it. And so like, there isn't a defined, like there isn't a, you can absolutely point to something. Conventional like wisdom and the smart money is saying when it converts, but it's so poorly worded. And the way for applying for QSBS, there isn't, you actually claim QSBS, file a form, and you don't ask for QSBS. So there's, you can apply that logic and you see people do it. It's not necessarily what kind of the most advanced or smart folks do, but there's not like a
Okay.
defined answer.
Yeah, it's a little bit gray. Okay, and last question, then we'll get back to some other questions. But um, at the time of gifting, how does the taxing work? What value is the tax assessed on?
The
Fair market
and
value, or?
Yeah, so the value of your gift, it's the fair market value when you gift those shares. So this
Okay,
is, let's take a scenario just as the fair market value up is $1 million. You gift it to your kid or a trust, and the trust sells it for 10 million. It's still on that $1 million value.
okay,
Um, Now this is where, and this is one of the kind of the nuances when companies go public, fair market value, and to your point, Anne, the later stage you are, fair market value and market value converge, and they tend to become almost one and the same. When it becomes public, they are one and the same. As it approaches that kind of time horizon, later stage, they get much closer. So the arbitrage gets smaller and smaller. Again, one more thing, do your 83Bs, encourage folks at early stages to exercise and take care of it.
perfect. Okay, now let's talk about how do you best plan for exits before the 5-year QSBS cliff?
Yeah, it's a great question, and it's something that it's not everyone here thinks that that's going to be their scenario. I think this is going to be a 20-year company. The reality is it's probably actually going to be the majority of exits. And so the key thing is this is where thinking about first off, start off with how do you want to use this money? Are you planning to spend it right away? So this is where candidly, if you're going to spend it right away, you have less tax planning options. If you need the liquidity in the cash, you can't use as many kind of tax opportunities to reduce it. If you aren't going to spend it, this is where more opportunities come into play. This is where someone has mentioned this. There's QSBS rollover. So if you angel invest or want to put into other companies, you can do that. And if you do that within 60 days, the clock on QSBS keeps going. Now, generally, I'd be surprised if people are on your exit table to put the majority of their funds towards this. But if you're not and you want to save this and are thinking more kind of long-term compounding and wealth creation, kind of the most common solution we see here is if you want to use those assets during your life is a charitable remainder trust. And the way a charitable remainder trust works is it's very similar to an IRA. It's a tax exempt structure. So this is kind of the example I was using before. When you sell that 10 million of equity, instead of paying 3.5 million in taxes, you can move that $10 million of equity into a charitable remainder trust, sell it. The trust is tax exempt, so it can take that, keeps that 10 million and reinvest it. And this is where $10 million growing starting this year versus 6.5 million, it's going to grow significantly faster. And because it's in a tax exempt environment, it'll grow faster. So it creates more value. And this is where, in kind of these startup situations, we usually see kind of the net return to a founder over their lifetime being north of 60 to 70% by selling their assets in a charitable remainder trust. But it really depends on how much do you need liquidity now. The more liquidity and spending money you need, the less options you have.
Okay, and can you say the name of the trust again that you mentioned?
Yeah, it's called a charitable remainder trust. It's also known
Okay.
as a CRT or
Oh, yes.
CRUT or
Correct.
CRUT.
Yes.
Um,
Okay, got it. And is there a practical way to transfer founder stock to a retirement account while the 409A valuation is low?
Yeah, so this is I think the way most people are probably most familiar with this is the Teal IRA. I don't know how many folks have you heard of it. I'm sure if you have, this is kind of, Teal has $5 billion in his Roth IRA, and this is, if anyone else can do this, like that'd be incredible. Now, bad news is the rules changed since Teal did this. So if you own a controlling interest of a company, you can't put this money into your retirement account. You can't put this money into your Roth IRA or IRA. This changed, I think, in 2002 or somewhere around that timeline. So the only way you can pull off what Teal has done is to essentially angel invest, do what Ann is doing, and do it from your Roth IRA. You can't move your founder equity in there.
Okay.
So this is why share remainder trust, or when you start to get into estate planning, that's the way you can focus on those tax savings, but you can't put your company assets in there. Now,
Okay.
one caveat there is some of your founding team members, early employees, they might be able to do that. And this is where there's companies you can work with. I think Rocket Dollar is an example that self-directed IRAs enables this, where you can have your company issue the equity to their IRA. You as a founder or someone who's a substantial shareholder can't do that because of IRA rules, but some of your employees might be able to take advantage of it. So that is something that you can consider, think more about.
Great. Let's see. Okay, so we talked about CRUTs. Should we also talk about donor advised funds or any other structures?
Yeah, so I think there's a couple, and to take a step back, a lot of this depends when you guys are going through equity exits and you start to have more and more, when you start to have bigger gains. This is one of the problems and the questions you think about in life change, right? And this is where it's typically when you're first earning money, it's like, how can I maximize the money to have during my life, right? And utilize for my family members, kids. Then you start to think about, how do I pass assets on to kids? Then it's, how do I pass it on to kind of grandchildren and kind of the future family? But then it also becomes kind of this broader meaning of life, right? Like, of how do I do good in this world? And you think about legacy. So there's a couple of charitable entities that people tend to use here. Donor advised fund, it's really kind of grown rapidly, and I'd say the last 15 years, it is, I'd say, the lowest hassle, easiest way to kind of give money away now. Still keep some control, but it doesn't give you a lot of kind of future benefits, and you give some future control away. So essentially, a donor advised fund, if you put $100,000 in a donor advised fund, or DAF, you get a $100,000 charitable deduction, but then you're limited to giving that money away to approved 5 charities and towards their causes. You can't create your own cause and implement that money towards that. Kind of the more advanced concept is foundations. And I'm sure folks here have heard of many foundations. Common ones are the Clinton Global Initiative, the Bill and Melinda Gates Foundation, the Ford Foundation. There's a ton of these. Foundations are, as you start to build up wealth, become a more powerful way to kind of, there's huge tax benefits behind this that are, it's funny. You see a lot of these charitable entities, and you're like, oh, it's great that they're giving. Candidly, the tax benefits even are just as good as anything, and make it financially positive ROI decision. Like, it's fairly common to see people give money to their own foundation. They'll set up causes that their family are really passionate about, can also create social value for themselves. There's a reason there's so many galas and things like that, is someone is getting a tax write-off to put on an event. It's also very common for these foundations to hire family members to be a part of, to create connections, to open up events. This becomes, as you start to build more wealth, you use foundations versus donor advised funds.
We'll have this conversation in 5 or so years. Let's go back early stage. What's the any advice for U.S. based founders currently living abroad?
Yeah, so this is so as I'm sure all of the U.S. citizens who live abroad are aware, the U.S. is one of 3 countries in the world that taxes citizens if they live abroad. So bad news, you're still paying U.S. taxes. The number one thing you guys should be aware of, there's something called FEIE, which essentially, I think it's about 130,000, might be a little bit higher. But if you spend more than 330 days abroad, they will give you, essentially, the federal government will give you a tax write-off on up to that amount of your federal income. So it'll essentially allow you to exempt it
Great.
because the idea is you're not using US services. So
Okay.
that's number one. The second piece is all these kind of tax structures we're talking about of charitable remainder trust, IRAs, estate planning structures, they'll come into play. As long as you're paying US taxes, these become valuable tools in which you can avoid, defer, push, or reduce your taxes. Um, so,
Awesome.
yeah. So,
Okay.
not much changes if you live abroad. There is one kind of unique tax loophole.
And two other questions. Do you have any recommended accountants that people work with, or do they work with them alongside your company? And if so, or if not, what are some good ways to work with a personal accountant? Again, this isn't your
Yeah.
company's taxes, it's personal.
Yeah. So on the personal side, it's funny. This is one of the top questions we get from like our customers is that they find it hard to get a good accountant. So we do have some people we refer them to, typically for specific situations like when you're filing for QSPS, things like that. Number one thing I'd say is if you're choosing an accountant, is picking out like what are your needs, what are your unique needs when filing your taxes, and kind of the assets that whether it's you're investing in or own, and asking the accountant of how many people they work with it, asking if there's the nuances and how they approach taxes, advice they give, to really understand if they're an expert for that. Here's the thing is, any competent accountant can file basic taxes, but being aware of QSBS,
Yeah,
1202,
100%.
some of these, if you expect to have large gains, like are they aware of kind of these tax exempt structures or GRATs and how to avoid those things? So understanding which problem you're going to be dealing with, what's unique about your assets, and asking them about that if they have a client base, to give some kind of either material or context they have, so that they'll be able to answer questions that are applicable to your scenario.
Okay,
Um,
so we might follow up with you to try to get a few service
yeah,
providers, but what we've noticed today is the good ones who work with startup founders. They're often, I mean, they're really backed up, right? So we need to
yeah,
continue to find good ones for this group. Good.
yeah.
Okay, so anything we didn't cover that you think we should really cover in this last 2 minutes?
I mean, I'd say the number one thing I'd call out is early stage is making sure folks, just hitting on this again, be aware of your 83B
Yep.
and early exercising, giving your employees a chance to do that. So the other thing to be aware of is make sure you understand QSBS, and also start to think about what you're going to do if you exit in these scenarios. I know it seems very hypothetical. If there's anything we've seen, and you could probably add to this perspective, is when these exits are happening, your life is going to be crazy. Like there's sales processes, IPOs, any type of liquidity event. It's never, well, not never, almost never a calm process. And so we see a lot of this where it's like these are big decisions you're making, and the financial impacts are truly life changing. And so doing some pre work, whether it's just some weekend reading, things like that, to understand what are your options, what you care about. If you have to have a discussion with your spouse about your priorities, doing that beforehand so that you can either set this stuff up now or be in a position to like quickly execute, because trying to parallel process this during a sales process, everything else in your life kind of goes out the window in these sales processes. So I'd say it's
Great.
like, it may not seem tangible, but it's really impactful. So do the pre-work.
100%. That's awesome advice. And I just think about thinking about at least part of your mission as a company is to create this sustainability for your team is an important part of the business in addition to like being overwhelmed with all the day-to-day, value creation of the business. So that's great. And then we'll provide some notes and context to your team. Can you just quickly tell us what is a client experience like with Valor?
Yeah, that's a great question. Just kind of a quick pitch on Valor. Like our entire kind of mission is to take these kind of tax optimization and planning strategies that billionaires' family offices utilize for their clients, and we use technology to automate and bring those best practices to everyone. So we make it really seamless. We have calculators, reading materials, so you can see what is the return or the ROI of using these various structures for your exact situation. How can, what are the trade-offs, and understanding with how do these structures work? What are you losing? What are you gaining? So we kind of bring the optimized structure so that you're not spending 10 to 15 hours with the lawyer. You can set these things up with 15 minutes. It's
Great.
all online. You can set up calls with us if you have any questions, but our entire thing is how do we make this simple, seamless, and accessible so that everyone kind of builds wealth in an optimized approach?
Great. Well, we have more questions, but we want to honor the time. And Mani, thank you so much for the expertise. And I'm sure you'll be getting a flood of villagers coming to work with you. So again, thank you so much for the time and the wisdom.
Really appreciate it, Anne. Enjoyed chatting with you. And of course, if anyone has any questions, we'll follow up with information on the key things we talked about, as well as how you can connect with us if you have any questions.
Wonderful. Great. Good.
Take care.